Welcome to a very special edition of the RiskReversal Podcast. I am Dane Nathan. I am joined by two folks that have been on the podcast before. Guy and I have been on their podcast before. They are prolific content creators. That would be Kristin Kelly, Jen Saarbach of the Wall Street Skinny. I think you guys know them. You love them. You probably watch them on their YouTube, on their really fun Instagram, and they have a newsletter and they have the podcast. Ladies, welcome back to the podcast.
Thank you so much, Dan. What a great introduction. We're so happy to be back here. It's so good to see you.
Well, it's what you guys do, we really appreciate, Guy and myself. And I want just you to give the audience just a refresher on the sort of content and really, I guess, why you started doing what you're doing. Our good friends at iConnections, they made the introduction, I want to say 2 years ago. I think Ron Biscardi was really amazed at the sort of traction you guys were getting at the content in which you were doing it. So give us a little bit about the mission of Wall Street Skinny and maybe how things have evolved over the last couple of years.
Yeah. I mean, so we started together back, it was 2023. And the main idea was, honestly, I wanted to learn about what the heck Jen did. Jen didn't know necessarily what I did. We both started on Wall Street back in 2007. I was in more of an investment banking vertical. She was in more of fixed income sales and trading. And, the mission was really to kind of democratize access to this information, but it also was almost selfishly, we wanted to almost learn more ourselves about what these other areas of the industry that, I don't think that people, when they get in their little vertical, necessarily understand what other people do. And so we did create it for almost someone who was interested in joining and working on Wall Street initially. I feel like now it's sort of taken on a life of its own, and we're now trying to create content not just for someone who wants to get a job in investment banking, but for people who want to understand what's going on in the markets. Why are interest rates doing this? Why is it if there's loss of confidence in the Fed, this happens to long-term rates? So we're trying to get a little bit broader than just this is the investment banking career path. But it was really kind of a project where we were trying to break down this, I think, not very well understood industry for other people, and then kind of also selfishly for each other a little bit.
Yeah, well, it's interesting, though, that you started out that way, but your audience has kind of moved along with you as far as the evolution. And I know that you have some of these explainer videos about the industry that have gotten hundreds of thousands or millions of views. So it obviously resonates with a certain sort of listener. And I think, as information about markets and the economy and stuff have been democratized, there's a whole host of new entrants and that's what we've found. So I want to get into the Fed. I want to get into a post that you guys did on SPACs and coming back here. And it was really, really good. Not just the breaking down of the structure, but some of the reasons why they've existed, why they went dormant, and why they're back. Let's start with the Fed. So just a kind of little bit of a recap. Everyone knows this, that, the president has been all over Jerome Powell, it feels like, for 8 years since the day after he nominated him to run the Fed. And, there's a lot of pressure. They want interest rates lower. They're attacking a Fed governor right now. They want to get rid of her. And then they probably want to go, once they have a majority as far as the Fed governors, then they want to go after the presidents. They really want to bring this meant to be independent agency, if you will, under the executive branch. So talk to me a little bit about how you guys are thinking about this. You guys started in the business at a time where the Fed was front and center to the global economy, not just here, and obviously the market. So how are you guys thinking about this? And again, what do you think about the independence of the Federal Reserve? And could there be some major reverberations if this is something that goes the way the White House would like it to?
Absolutely, Dan. I think one of the most challenging things about the current environment is that the means of bringing about a monetary policy change, if there's any perceived lack of credibility for the institution that is controlling our monetary policy, it calls into question so many things beyond just what the federal funds rate is overnight. And so when we both started in the industry, I was working at a little firm called Lehman Brothers when we took down the entire global economy. And I was sitting on the trading floor watching this historic event of quantitative easing being implemented. And we have come on a very long journey since the financial crisis of 2008. But I fear we didn't necessarily learn all the right lessons along the way. And actually, one of the things we talked about in our episode 2 days ago was right now where we're sitting, everyone's been so focused on the Fed's dual mandate, thinking about the labor market picture and obviously the inflation picture. We have a lot of unknowns on both fronts, right? We have a lot of unknowns on the inflation side of the equation because we don't know exactly how tariff policy is going to flow through. Chairman Powell himself said on Friday that, listen, we don't know if these shocks are temporary. We don't know how much is going to be pulled through. Perhaps they are. We got this terrible payrolls report that was then called into question when we summarily had the chief of the Bureau of Labor Statistics sacked immediately upon these massive revisions happening. And we got what ultimately was a 100% pricing in of a Fed rate cut in September as a result. Now, Powell came out on Friday and was super dovish at Jackson Hole. And you had everything there in that speech to guarantee that rate cut. Why we now need, or why all of a sudden the necessary course of action seems to be to go after appointees on the Fed's Board of Governors that were appointed during a previous political administration to, in hopefully, I presume, right, to install somebody who's more favorable to the Trump administration's policies. Why do you need to do this in a way that throws into question the entire sanctity of the organization, if you will, when if simply you let due process play out? I mean, you can't fire someone for cause without any cause being established. So to me, this is a very simple question of due process that has massive far-reaching implications. And by the way, no one should understand better the necessity for an independent central bank than the current administration. Scott Bessent himself was part of the team that took down the Bank of England. Have we not learned lessons from the past, right, in terms of central bank independence and its importance? So it's something that I feel very passionately about and hope people understand the risks.
Wait, Jen, you're speaking my language, and I love the excitability. Kristin, talk a little bit about how, what's some of the feedback that you get from your audience when you kind of lay this sort of stuff out? Because some folks see it as very partisan. You know what I mean? And I think I think that's okay, because the White House is being very partisan about it, and the intellectual dishonesty that we're seeing from folks like Secretary Bessent, like, make no mistake about it. Like you just mentioned, like, he went after a whole host of different institutions and different trades, and really just to make money for his LPs, that sort of thing. So now to find yourself, the Secretary of the Treasury, and having this sort of influence on this institution that is meant to be independent. The Treasury is not meant to be independent. You know what I mean? Like, right. But so I'm just curious, what is some of the feedback that you've been getting from your listeners, from your viewers? Just give me the 411 here.
Well, I think it's so interesting. And, a lot of times when Jen and I are talking, I'll always say to her, like, we need to establish certain things. Like, number one, the Fed is not just Jerome Powell. He doesn't just decide by fiat, we are lowering rates. It is this, governing body, like it's the committee, right? The committee votes. And this is how, you make up these members. And, also if rates are dropped, like, what happens to long-term rates? Because those are not necessarily like the same thing. And so I think it's so interesting because so many people who might actually be very well versed in different parts of the financial ecosystem don't necessarily have an intuitive understanding of how all these different things work. And, again, Trump obviously makes things very political. I will say something else that I've always noticed is that people tend to really care about stuff when things break. So it's almost like the fact that he's pushing things to the breaking point makes a lot of people step up and care about the Fed when they obviously, like, normally in their day-to-day, like, don't care. But you're 100% right that there's definitely, we could say something that just literally explaining how the Fed works, and it's like, you clearly have your thumb on the scale, like, you are so clearly a Democrat or so clearly a Republican, and people get so angry about, and we're like, we literally are just explaining how the Fed works. Like, this isn't political. This is just like, this is how 1 + 1 = 2. So it's really interesting, but I do think one of the main points, though, that I think Jen gets surprised about a lot, I don't as much, is just that there's so many people that really don't understand how this stuff works. And so even like having to go back to basics and be like, this is how this thing affects this other thing. And by the way, just like putting in someone who's, going to be sort of doing what the president wants doesn't mean that long-term rates and mortgage rates are going to be lower because, he does this one thing. And if anything, it might actually shake confidence, therefore leading to higher long-term rates.
Well, so, I think that's the most important point. I was on MSNBC last night and, speaking to an audience that can be very different than a CNBC audience. And I had done that just a few hours earlier. And, my point in that show, I actually made the same point in CNBC, is like, okay, this is going to get political. It's going to lose its independence. There's a whole host of other things like you guys just explained that are knock-on effects that, some folks are not, maybe don't understand and could happen. And, my point was, okay, if I'm Fed Chair Powell, maybe I drop the mic and say yours. And so fuck around and find out, because, we could find ourselves in a situation, dollar starts careening. Longer and like the
more.
Yeah, well, but think about what happened in April. Like what if we have a Dixie trading in the high 80s? What if we have yields that on the long end they start going up because they fear inflation? I mean, there's a whole host of things that could happen, and I just don't think those are being accounted for right now. But it is what it is. Okay, this is not maybe a great segue, but a post that you guys had on the SPAC king. That was Chamath Palihapitiya. I think Axios had an article talking about how he's launching a new SPAC. He was also one of the most prolific issuers of SPACs in 2020 and 2021. He had Virgin Galactic, Open Door, Clover. I think it's important to note that those three all basically went to zero. I mean, Clover's down 75%. Open Door is now, this guy Eric Jackson's trying to make a meme stock out of it, which is its own scam. I mean, for whatever that's worth.
Agreed.
And then Virgin Galactic basically went to zero. The one that worked for him was SoFi, and it's worked very well, but I think he's out of it. I think he was out of all of these sorts of things, and there was lots of bag holders. You guys walked through the mechanics of a SPAC. One of the reasons I thought that was really important, because they're coming back, obviously, and the SPAC king. So let's talk a little bit about some of the dynamics that were going on back in 2020, post-COVID. People were getting their stimmy checks. Rates are zero. There's a full-on mania in markets. We saw it in meme stocks. We saw it in SPACs. We saw it in unprofitable techs. We saw it in NFT. I mean, the list went on and on. But they're all back, right? So tell me why you guys chose to break down SPACs, because before you guys speak, I just want to put some numbers around this. I went to ChatGPT and I was asking about how many SPACs and the dollar amounts, this sort of thing. And this is fascinating. It said to me, according to SPAC Analytics, a source that doesn't lie much, which I thought was amazing. It's being a little cheeky there, okay? So in 2020, there were 248 SPACs equaling $83 billion. It was 55% of the IPOs. 2021, 613 equal to $163 billion in market cap, 63% of the IPOs. 2022, there were only 86, 14 billion. 2023, 31, 4 billion. 2024, 57, 9 billion. And now already we're more than midway through the year, 84 at 17 billion. But the pace in which we've seen from a dollar amount has dramatically, decreased. You're not going to see that market cap happen until you start seeing the SPACs happening. So there's the numbers. Let's hear why this interested you, this topic.
I'll let Jen go, because Jen was the one who was like, we have to do something on SPACs. So,
well, no, I think just more thematically, I think one of the things that you just mentioned is like what's old is new again, and market cycles are happening so much faster, right? So we were in this zero interest rate environment, and now we are coming back to what is clearly going to be an easing of monetary policy. But in the same time frame, what's also happening is we're getting this massive push towards retail investment in private capital. Mm-hmm. And what SPACs were in 2020 was kind of private equity for the Reddit community, right, if you will. And so I think that what's old is new again, and people are saying, well, wait a minute, right? If there is all of a sudden this big push, remember this old tool? Let's bring this back and revisit it. And now with some new iterations on it, which I think Kristin should explain, where maybe potentially like there's a difference in how sponsors particularly make their profits, and also in terms of maybe where other institutions can get involved. I think that the name of the game has changed a little bit. I don't know that the messaging is any different, though.
Yeah, and I think just to follow up, these are, structures that I think a lot of people don't understand exactly how they work. And if you look into just some of the fee structures, it's kind of insane. And so, when you think about just most people, I think these days, especially on the retail side, are told like, put your money into index funds, like don't pay fees, like don't invest in hedge funds, 2 and 20, like bad. And so when you look at a SPAC, very simply, the sponsor, and it can be someone who has zero experience managing, or basically zero experience. I feel like Martha Stewart has experience managing companies, but doesn't have necessarily the financial experience that you would typically expect of, say, like a private equity investor. And so there's these different sponsors who they go out and they do an IPO. They're basically raising a giant pile of cash. And then obviously like the second part of this whole SPAC is once that IPO process has gone through, they then have to go find a company, the private company to buy, which then makes that private company become publicly traded. But the thing is that when you're going out and doing that initial IPO, the way that the fees work to the sponsor is the sponsor basically owns 20 to 30% effectively of almost like that cash pile once that merger goes through, which is kind of insane. It's like you're buying into something and you basically get like 70% of it when all is said and done. And so the one interesting, I guess, nuance or change, I should say, to some of the earlier SPACs. So in like 2020, a lot of times the sponsor would get, say, 20%. So that whatever, it's the promote, but they would get 20% ownership of the shares that were issued. Now there's the new crop of SPACs, and at least the one that I had looked into, which was an American Exceptionalism Acquisition Corp. The way that the promote works is the sponsor is actually going to be getting 30%. Now it is subject to some share price hurdles, but it's interesting because it's so like in that meme stock mentality, because the sponsor will get those 30% of the shares if the share price of the SPAC, like post merger, if it trades sort of like double the share price for 20 out of 30 days. But the point is, it's a very short-term bogey. Like, it's not like this is what is the performance over 5 years, which is a long-term hurdle. And by the way, we can see what happened to the 2020 SPACs. 5 years from now, or 5 years from when they were done, their share price performance has been abysmal. And so you have this, again, the sponsor, they go out, they do the SPAC, and then all of a sudden they're going to own 30% of this thing and they can sell out, within 30 days.
All right. Let's take a step back and let's talk about incentives, because I think you guys are nailing this right here. So if you have price performance over a short period of time, that's where Reddit and Twitter and memes come into play, right? So think about it. So the incentives of the sponsor, they put up like 10 million bucks. They basically use their notoriety or their pedigree to go out there and tell a story how they are going to be able to find some great private company. They can't tell you which, or they can, like that's part of the rules. Give me your money, and I'm going to find something that's going to be a great stock in the future because it's a great company and my ability to kind of get access to that. But your point is, they're taking 30% of that, right? They have every incentive in the world, right, to kind of follow through this, promote, their ability to raise the capital, and then promote their ability to find a target and get the deal done. Now, if you're a company, the idea of fast tracking an IPO and getting out to the market in an environment like this, where a lot of these SPACs in 2020 and 2021, they became meme stocks, right? And that was probably interesting to some companies. They probably learned a lesson, though, that was fleeting, right? A little bit. And then in the middle of that are the bankers. They love this crap. Like, keep bringing it, right? Because we'll do the deal. We'll do deal after deal. And then they'll do advisory on the acquisition process and the closing and all that sort of stuff. So all the incentives seem to be, leaning towards the folks that, have the knowledge and have the experience. And then the bag holders are the people who being convinced, because these promoters, they go on, and I mean this sincerely, they are promoters. They go on every media and they're just pumping it up, right?
Mm-hmm. I mean, not only that, by the way, the other little wrinkle with these SPACs is that if the sponsor doesn't find a company to buy within 2 years, they basically have to give all the money back. So there's also the incentive to almost like do bad deals, because you don't want to give all the money back. Like, they get 20, 30% ownership. And I mean, 20 to 30%, even in something that's going to like not do that great, is still better than zero. So it's totally, I would argue, misaligned there as well.
Yeah, and part of that is, so you put the money up, you can't find a target, you have 2 years. There was definitely some folks who were kind of pushing out the count. I don't know how they did it, but the timelines, that sort of thing. And the last thing that these sponsors, wanted was that their 10 million bucks or whatever the number was. It might be relative to the amount of money that you're raising. I can't remember exactly what it was, but literally you didn't find a target. You could give the money back, but sometimes you could eat it too. What do you guys think about the environment right now, as far as if these SPACs come back really hard in the back half of the year? Even with interest rates, which by the end of the year, we're going to Fed funds, it would probably be very unlikely it's going to be below 4%. Talk to us about that monetary policy and how it affects risk-taking in a sector or a group like this.
Well, yeah. So, I mean, listen, the very basic theory here, right, is that as the Fed disincentivizes you from parking your money at the bank or at the Fed or from anywhere else, you're going to push it into riskier assets. And what better thing than the sexy private company that's going to make this massive return in 30 days or less, right? If it sounds to be it sounds too good to be true. It typically is. And so I would caution, right, against the investors out there who look at these things as, okay, well, I've got nothing else to do with my cash, might as well take a flyer on one of these SPACs, and that's fine, right? I would think about it like any other risk asset in your portfolio, and think about it as, okay, this is effectively a lotto ticket, right? And think about it accordingly, rather than thinking about, gosh, this is my retirement plan, right? Like, I am going to put my 401k, my entire thing, in a SPAC. And I am not licensed to give investment advice, but that's how I would approach it at the very least. And I would think about this too, as rates fall, are we going to see more deals in the conventional space that are facilitated by this opening up at capital and this incentive towards risk taking that might be higher quality deals that lead to potentially like growth in more organic, sustainable, fundamental ways that aren't, hey, let's basically find a way to backdoor IPO a company that otherwise didn't have the criteria to be taken public in the classic way. We did an entire deep dive on WeWork, right? Which had a failed IPO and then ultimately went public via SPAC just to then declare bankruptcy, right? When I think of, you talk about open door, in my real estate life, I have never once sold an open door property for very good reason, right? Like, these are failed business models in lots of ways. So when the fundamentals aren't there, I do think that there's a lot of opportunity for potentially some ne'er-do-wells, whereas I think that a falling rate environment might encourage risk-taking in more constructive, fundamentally positive ways.
Yeah, but Kristin, when you think about this, and thank you, that's a great summary of just kind of why these things happen at these sorts of periods. And so if you're anticipating a rate cutting cycle, your point is you're going to go and you're going to try to find some riskier assets. But when you look at like an open door as a great example, it was a meme stock once, and then it became a meme stock again. In between that, so much money was lost. Like why do investors not learn these lessons? I mean, I get these questions all the time, but all you have to do is go to your fact set and pull up an open door chart, and you see when it went public via SPAC in mid 2020, and it went from $15 up to $38, and then it was trading at 50 cents just a month ago before Eric Jackson started pumping it in a it's just embarrassing. This guy is posting videos of him standing outside of Drake's house in Toronto or something like that, and he knows there is no fundamental value to buying this stock here. So why do investors continue to fall for this shit?
I mean, I think it goes the same reason that people buy and, trade in the shit coins. Like, I hope I can say that on here, but it's one of these things where it's like, Matt Levine had this great newsletter where he was talking about actually like AI colluding with each other. But he was like, there's this philosophy, or not philosophy, but we like rediscovered that things go up because people buy them, right? It's like, now typically we buy things because they have good earnings, right? And there's actually like actual cash flows that underlie the business. But at the end of the day, if you expect that, it's that greater fool's theory that someone else is going to be out there and there's the whole community of the Wall Street bets guys who are all going to be buying this thing, and you just have to go along for the ride, you can double your money, especially if it's like it's trading at 50 cents. It's just to go to a dollar and then you're out. So I think that it's one of these things where people are, taking bets on some of this stuff. And even in my, I have friends who work on Wall Street who are very smart, and they will even trade in some of, again, like the shit coins, because they're literally looking at it, to Jen's point, like a lotto ticket. It's like, you just have to buy one, whether it's Dogecoin or Fartcoin. These things are ridiculous, but to me, it's the same thing, when people have money to spend, and it's this like, everyone's super rich because the market keeps going up, and there's obviously like things on the horizon that are a little shaky, but things are still going up. Like, stock's doing great. Like, I think it encourages this type of behavior. Or if you've missed out on the uprun and you're like, well, I want to at least make some money on taking a bet on this thing.
Yeah, one of the things that I guess has kind of emerged over the last, call it 6 months or so, since the downdraft in the market, and there's been a lot of data about this, that like retail really didn't get shaken out in April. And I think that's interesting. And, a lot of fancy hedge fund managers or pundits on TV, and maybe me included, that sort of thing, we're really thinking about things maybe too intellectually. They got too much in the weeds about, what does a weak dollar mean versus versus, the 10-year yield that just almost spiked to 5%. And then, what was going on in the 30 and, like all these rate differentials and this and that, whatever. And you're like, wait a minute, if we're going to have a protracted trade war, this is like my history tells me I go back to the late 70s, all that sort of stuff, right? And we keep talking about stagflation. Well, retail's like, I don't give a shit. Like, I buy every dip because every dip was smart to buy over the last 15 years. You know what I mean? And they're right. It just depends on your time horizon. So in this environment like that we just discussed, where there's just lots of activity that kind of brings us back to 2020 and 2021, right? Falling for all the shit stuff. And we probably know how it's going to end. Those folks who are looking to kind of go down the risk curve, why not, if you think about this really exciting theme of generative AI, right? And we know that there's basically 10 stocks in the US stock market that have accrued most of the benefit of this hundreds of billions of dollars of CapEx. They've reaped trillions of dollars in market cap. Why is that not good enough for these investors? Every time they turn on CNBC or they go on the internet, all they're hearing about is NVIDIA at $4.5 trillion or Microsoft at $4 trillion. I mean, like, shouldn't those names be good enough to kind of play a theme that is going to dominate the markets up and down probably for the next 10 years plus?
I think, though, that there's two things that you've hit on there. One is this bifurcation between retail and institutional, that there's almost the same way that we talked about dismantling trust in these institutions that we've built up kind of at a bigger scale within the country. There's also a distrust of institutions. It's the same kind of, mistrust of institutions that led to some of the more nefarious elements of the meme stock boom of 2021. It was, let's go after these hedge funds. Let's squeeze them. These are the bad guys, right? These are the guys who caused 2008. Right? Let's get them. And I think that there is that still bifurcation that's saying, well, listen, all the talking heads are saying the exact same thing. I was wringing my hands, by the way, talking about the specter of failed auctions. And we got Steve Eisman on our podcast and he was like, calm down. Everything's going to be fine. You know what? He was right? I was exactly one of those same people who had the exact same thoughts looking at the fundamentals. And when you get enough of those lessons learned, it's which lessons are you learning from the information, right? And I think there was very much a large portion of the retail audience that said, I heard about all these people. They made a movie called Dumb Money, right? About how the smart individual can beat the big bad institution, right? I want that story. I want that story for myself. And I heard about my neighbor who made a killing in Fartcoin. And I heard about this person who made it in a meme stock. I want to be part of that. That's much more fun than saying, I'm just going to put my money in a diversified portfolio of 70-30 or 80-20 and not look at it again for the next 20 years, right? There is that hubris, I think, that comes from those stories. That storytelling is really powerful. And I think we're seeing that play out in people's financial decisions. And I think the other thing too is that at the end of the day, when it comes to the generative AI and when it comes to the companies that have, I think if it were everyone trying to pick, okay, who's going to be the winner takes all, who's going to be the winner takes most, right? That's one question. But what we've really seen in the stock performance is that it's been the companies who are the picks and shovels, right? It's who's going to build the infrastructure, who's going to build the chips, who's going to build the data centers, right? That's not the sexy story, right? Everyone wants to be the one who's like, I knew it was going to be Joe Blow in his basement with the thing, and he built the AI that now replaced all the humans, and we have the Terminator. Great, right? Whatever it is. I think we're just not quite there yet, and everyone's chasing that high. There is a very emotional element to trading. If you are a retail trader with a Bloomberg terminal behind your screen, that you just don't get that from the boring park it in QQQ and walk away.
Jen, that's really useful because when you think about it, the Gen AI trade has not been particularly sexy. I mean, NVIDIA makes these high-end GPUs. They have basically 90% market share. It's the server makers that put them in their servers. It's the data center companies who put the servers with the GPUs in the data centers. And then it's these companies that license the compute, to train the models, right? And so it really is, if you think globally, it's probably 20 companies, right? And they've accrued, again, probably 80% of the market cap that investors have poured into this sort of trade. And I'm just curious, like, when you think about this from the standpoint, Kristin, of like all of this investment, it's been a one-sided trade. And again, it's been a narrow trade, and it's driving so much of the performance, not just of the market, like the S&P 500, where they're 40%, or the NASDAQ, they're 50%, but it's also been a huge driver in the economy as far as CapEx. And it's been a huge driver of S&P 500 earnings. And it seems like, it could continue to go this way for a bit more, but it can't go that way for that much longer. And you're going to need other parts of the economy and other parts of the stock market start to pick up.
Yeah, well, I think also you just hit on something too, which is, as you have like these new records being set, I also think that if you are the retail buyer or if you're anyone, you might think you've already missed out, by the way, on some of these. I mean, we keep hearing about how, Sam Altman last week said he thinks that we might be in a bubble with the AI story. And you had the MIT study that said like 95% of companies are not seeing return from this generative AI. So I do think that there are possibly also people that expect there to be a possible correction in some of these companies. Long term, I think that people mostly believe in the story, but I don't know that if they necessarily are in the short term 100% on board. So I think that also could be coming into play. Whereas again, back to like, why is it not good enough to just invest in QQQ? It's like, well, if I buy into whatever it is, Open Door, and it's trading at 50 cents, it only has to go to like $1. Whereas, I mean, as you said, Nvidia's $4 trillion right now. It would need to go to $8 trillion. And it's a lot of, you know what I mean? Like, so yeah. the volatility of that short, I mean, I don't know, like that seems to make a little more sense if you're trying to just get like a nice little pop.
Yeah. And listen, none of us know if it's different this time or not. I suspect it's not different this time. Before we get out of here, I want to get each one of you to tell me something that you believe, let's say, about the markets or the current market or economic environment that you think most other folks don't believe. And I know that is probably not that easy.
You're teeing up for a Jen Saarbach conspiracy theory. You guys, watch out.
But the point, the reason why I ask you this is like you guys really dig into topics, and I don't think you put the mic on or the camera on to discuss these sorts of things unless you've done the work and you really believe something. And oftentimes you guys are not afraid to go against the grain. So I'm just curious, is there something out there? You just gave the example of the Fed and breaking down, how that independence is supposed to work, and people come at you and say, no, you're just being a snowflake or this and that, whatever. So I'm just curious, what are some things that you guys have been digging into that you think a lot of folks have not come around to just yet?
I think we are on the precipice of a financial crisis that might need to be averted literally in the next 3 weeks. I'm not messing around here, Dan. So if you look at what's actually happened, a lot of people forget that we are in a regime of quantitative tightening. The Fed's balance sheet has shrunk by something like $2.5 trillion from its peak. And at the same time, the reverse repo facility has shrunk from a peak of $2.5 trillion. All of that tightening has come from the reverse repo facility. So where is all the cash left in the system? Well, it's left in bank reserves. Okay, where are bank reserves? They're at something on the order of magnitude of 3.3 trillion. And what should that be as a percentage of GDP? Well, there's no firm number, but it should probably be on the order of magnitude of, call it 10% at a minimum in order for the system to function. Well, what's coming up in 2 weeks right before we have the Fed meeting? We have September 15th, we have corporate tax payment day. So all of a sudden, we're going to see a massive draining of those reserves across the street, right? Then what happens? If our GDP is, call it, I don't know, what are we like, 33 trillion, something like that, we could drop precipitously low. The last time that happened was September of 2019. And if you'll recall, that's when we had what we affectionately call the repocalypse, right? Where GC blew out from, call it 2.5% to 6% in one day, totally collapsed the basis trade and caused massive panic. And that led the Fed to implement the standing repo facility. So here we are again, and you're watching Fed funds GC. It's going a little more negative, right? It's now at -5, right? Something like that, 1-year Fed funds GC. It's starting to be a sign of stress in the system. And I think that there is the possibility that Jerome Powell had that in the back of his mind when he stood up at Jackson Hole on Friday and why he was so dovish. I think that we might also see something, you talked about kind of the bipartisan nature of these things. Michelle Bowman has been single-handedly leading the charge to have supplementary leverage ratios, to have treasuries excluded from that, right? To obviously have more things flow through in terms of banks being able to do the work, right, of helping keep liquidity in the system. I wouldn't be totally shocked if over the next month we got more progress towards ultimately a resolution on that.
Wow. All right. So you don't think people are focused on that? And what could, yeah. What if we had a what would you call it? Repo-pocalypse? Repocalypse? I for some reason have a hard time saying words with that many syllables. But
making a portmanteau.
what would be the thing that basically is like, screaming in silence about some sort of crisis that could happen on September 15th into the Fed meeting?
Well, you no longer can find levered long positions, right? So you all of a sudden see treasuries sell off across the curve because all of these banks that can't hold treasuries on their balance sheet, right? They don't have the cash in their reserves to do so, right? And so as the treasury is issuing more and more and you're saying, hey, we need to cut rates. Well, guess what? In that environment also, we now have to fund the big, beautiful bill. We're issuing more than ever. And now no one can buy these treasuries and there's no cash in the system. So I think that's the potential risk that no one's talking about is everyone's like, well, we're going to get a steepening of the curve into the Fed, right? Okay, we'll get a bull steepening, sure, because you're pricing in lower rates. But look at what's happening in Europe. The ECB has cut, 8 times in the past 2 years? And what's happening? Their long end is selling off. Look at every single government bond in Europe and in the UK. Their long ends are selling off. We could get that twist steepening of our curve where, yes, front end rates come down because the Fed takes action there. But all of a sudden, the long end becomes totally unhinged, like you referenced earlier, what could potentially happen in the long end, because who can fund these levered longs?
Whoa, Kristin, that is a hard act to follow. What is the thing that you believe that lots of investors don't believe at the moment?
Well, I mean, I kind of similar to what Jen was saying, would not be surprised if Trump does all of these, machinations with trying to get a majority of the board of governors, he's going to put obviously a new Fed chair in next year. We get the turning over of all the Fed presidents. Now you have, again, the FOMC is, more on the dropping rate side, but what's happening in the long end. And so I don't know. I mean, I wouldn't be surprised if we get quantitative easing again, because they're going to, to Jen's point, I wouldn't be surprised if rates start to go higher, right? They sell off. And then to obviously for the average person, they care about mortgage rates, and mortgage rates are obviously usually benchmarked to the 10-year treasury, and cutting the short-term rates isn't necessarily going to help. So I don't know. My guess is we're going to see quantitative easing sometime next year.
Right. And that should be inflationary also, right?
Yes.
So
Yes.
it's just a lot of stuff right now that doesn't kind of speak to the reasons why the White House wants interest rates to go lower and again, stable prices and, full employment. Well, employment doesn't look that full right now. And then from, inflation standpoint, it's not going in the direction that the Fed wants it to. And, to your point, Jen, about something that technical that a lot of folks aren't, it really feels like it could come out of left field and, really kind of fuck some shit up. But I'll just leave it at that, I guess. Well, we're going to have to revisit this conversation, and we'll put aside all the SPAC BS and all the other stuff, because that was we saved the best for last a little bit. And by the way, before we were coming on today, Bill, who's our in-house comedian here, who also runs our studio, he said to me, it's interesting that the ladies never had you on when you were fat. So I think I met you guys right after I started taking Wegovy. And so thanks a lot. I mean, now I know why I get my invites here,
I will say, just because we get asked all the time, where the name came from, it's literally just the down low. We wanted to pick a name that was more feminine, because so much stuff in finance, we're for all people. I don't care if you're male, whatever, we're for everybody. But we did want to have a slightly more feminine twist on our name. And we were like, the Wall Street Download, the Wall Street Scoop, those are all so boring. So we were just like the Wall Street Skinny. But then everyone is like, what is that name?
No,
so anyway,
it's a great name. And now I'm just glad that I could be a guest on it. They only had me, Bill, on audio the first time around, but now I can be on video. All right. Well, listen, Jen, Kristin, thewallstreetskinny.com. You got a blog, you got a YouTube channel. You can listen to them in your favorite podcast store, but also the most fun that goes on in the Wall Street Skinny is on your Instagram. So go follow them there. So thanks, guys. I really appreciate you being here.
Thank you so much. It was a pleasure.